Hello and welcome to this edition of 401k and Beyond. I'm here with Eric BALCHUNAS, who is the senior ETF analyst for Bloomberg. How you doing today, Eric?
I'm doing great. It's great to be here. Thanks for having me.
Yeah, it's great to have you on. So you recently wrote the book, The Bogle Effect. So the first thing that kind of jumped out at me was following you for a little bit, on Twitter at Eric BALCHUNAS. You're an ETF guy, and Jack Bogle wasn't necessarily a huge ETF fan, right?
Yeah, it is. I get that question a lot actually, and it's a good one because why would I write this book? I like ETFs, and he didn't. But that's kind of part of the inspiration for the book was that when I went to interview him for the first time in 2014 or 2013, it was around then. I was writing a book on ETFs, and I got in there, and I was just expecting to get a couple of quotes from him about like Vanguard and low cost or whatever, but he wanted to debate, and we instantly got into it. He had papers spilling all over his office. I mean, he's 84 at this point. I mean,
Mhm.
I just, but he had it. He was like doing my job. I mean, he was like a fund analyst. He knew all the new ETFs being launched, even obscure thematic ones. He'd show up like the money weighted returns of like the oil ETF and complain about it. And next thing you know, I'm in a very collegial debate with him that lasted like an hour and a half. And that happened three times. So it was being an ETF person that I think got him going in a conversation. And so a lot of that material, that debate, I was able to bring out, I think, a lot of interesting information and a lot of the relevant debates today. In addition, I think that the ETF industry would be a tiny fraction of its size had Bogle not existed. And the reason for that is the ETF people who started the ETF were actually influenced by the index fund. Obviously, that existed, and that gave them the idea. And when they went to when SPY, the first ETF, launched, and they went to give it a fee, they chose 0.20%, and that's because the Vanguard 500 index fund at the time in 1993 was cost 0.20%. It wanted to be even with that. So by having that low fee already out there, the ETF matched it, and by being cheap, instead of charging a 1%, but charging a fifth of that, it started the ETF off on a major good foot because then it could then get out into the retail world much easier. Retail would be less interested paying for 1%, although traders would still use it. But anyway, I think he had a big effect on the industry, even if he did have issues with it or parts of it. But I guess that would be my answer as to why I felt somewhat relevant writing about it.
Oh, that's good. And before we went live, we said we're going to keep it very, very simple, and we want this to be for a broad audience. And of course, we went right into ETF without explaining. That's an exchange traded funds. That's a basket of securities that trades throughout the day unlike a mutual fund, which trades once a day. You kind of buy it and get it at the end of the day. So that was his concern, right? That the ETFs would prompt people to trade more during the day, which usually doesn't work out well.
Yeah, an ETF is a mutual fund. The best description I've heard is it's a mutual fund with benefits.
Hmm.
You can trade it throughout the day, but it does the same thing. It tracks a diverse group of stocks, and largely most of them follow an index. There are now active ETFs which do like Kathy Wood or whatever, but that's generally what it is. And Bogle didn't like two things about them. One is trading. I mean, he thought you should buy and hold a fund for 50 years. So what's the point in making one that trades? I mean, there's just no point. It's just a distraction, unnecessary. The second thing he didn't like is all the marketing. He felt that a lot of the marketing engine of Wall Street entered the ETF world and just started cranking out anything left and right. Again, a distraction. So those are his two issues. But he would admit that if you bought and hold a broad market index ETF, he had no problem with that.
Hmm. And one of the things we like to talk about is your 25-year-old who's putting away $25 a week. So picture you're, in a break room, you're doing a 401k enrollment meeting type of thing. How would you explain to somebody who's new to investing overall how much, the title of your full title of the book is How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. How would you translate that to your regular 401k participant just getting going? How much an impact this person had on what they're doing for the next 40 years?
Yeah, I mean, I think I think the chart I would use, probably the most effective one, is if you if you took $10,000 and you invested it in something that gave you 7% annualized return a year. Oh, in 50 years, you'd have $300,000. Okay. If you took the same $10,000 and invested it in something that gave you 5% annualized returns, at the end of 50 years, you'd have just over $100,000. So you're basically getting an extra $200,000 on that 10,000, right? That's almost like twofold more in dollar terms if you go with the 7%.
Mm.
An index fund got you to the 7. Before that existed, you were getting 5. And here's what I mean. Whether it's a 60/40 or a direct equity market exposure, if you have an active mutual fund manager, you're probably going to miss the market return by 2% because that's how much the fee is and the trading costs inside of it. So what Bogle did, I think, in his big life's work was addition by subtraction. He slowly over time removed the management fees that were in between the investor and the market returns. He also removed the trading costs. Index funds don't really trade the stocks in them much. Maybe there's a little rebalancing here and there, but it's very minimal, and there's no fees there. He even removed brokers from the situation. So and even human emotion and bias. I think an index fund, you just buy it and hold it. You don't need to try to day trade it. So by removing all of those things, you get the 7%. And by getting the 7% and letting that compound, wonderful things happen over the long term. So this is part of my book, was that an index fund at surface seems like average. It seems like something you wouldn't want to do. Bogle, over the years, had to really make the case for why it wasn't average and why over the long term, an index fund actually will beat all of the active funds. Maybe not 1 year, usually a third of active managers will beat the benchmark in any given year. That number slowly declines over time. 10 years goes down to like 20%. 20 years is 10. You get the idea. So an index fund over 20, 30 years is going to slowly rise to the top of all those returns, and you're going to get more of your money. And the dollar impact over time with the compounding really adds up. So if you're young, I think that's really important because you don't want that friction costs and those fees to completely eat up those returns that you want in 40 years. So you have to think long term to get with the Bogle effect and what he did. My theory on young people is they have to learn the hard way. I think a lot of them are traders. They're into crypto. They want to do Robinhood. And when they turn 30, they'll have seen a bear market, and they'll probably get married, maybe have kids, get a house. They'll get serious, and they're going to really look at that 50-year chart. It's going to be way sexier than it is when you're 20, 25. Mm-hmm. So I would say if you're 25, maybe already anticipate you're going to go through that, and then you'll, I think, appreciate what Bogle did, which is to take all those frictional costs out of investing and really make it easy. You just hit a button or two, and you own the whole market for almost no fee. And if you can hang in there long enough, you will beat all the pros. It's beautiful, and I think he deserves almost all the credit for that.
Yeah, that's really interesting. And he wasn't always. He didn't come out of college looking to start an index fund, right? It sort of happened based on a few different things that happened.
Yeah, and I won't go into the details because it can get boring and wonky. I tell the story in the book as best I can, but he went to work at an active mutual fund company out of college in the 60s. But they were too conservative. They teamed up with a growth manager, like an ARC of their day, like Cathie Wood. And then a bear market came, and there was a falling out. And Vanguard was really formed as a back office company, just so he could keep his job to a degree. That said, Bogle had written his Princeton thesis, and he talked about being fiduciary. And some of the tenets of his low-cost life's work were in that Princeton thesis. So I will say there was something in Bogle that was seeing this, but the circumstance really was a huge part of it. And that falling out with his old colleagues, he had to get creative, and he wanted to. Again, I won't go into the details, but he thought a way to solve this problem was to come up with a mutually owned fund company that did the back office work for these other funds. And that back office company that's mutually owned, the funds own the company, that was called Vanguard. And at the time, nobody cared. It was back office, whatever. They weren't doing anything. But 2 years after he formed that company, he read about the indexing concept, and he decided to start an index fund at Vanguard because one of the deals he made with his partners that they had falling out was Vanguard won't run money. We'll let you guys run money. We'll do back office, and that's how we will coexist, even though we hate each other. Anyway, an index fund isn't technically running money, so it was almost a quirky loophole for him to run money without running money. And so it's interesting, I think, business study, case study in the book, as we get away from, obviously investing is a big part of the book, but I've seen this pattern in businesses a lot where somebody gets handed, lemons and they just find the greatest lemonade out of that bad situation. So the index fund, I think, was a perfect match for Vanguard's mutual ownership structure, and also a lucky break for Bogle, who wasn't allowed to run money technically. And so that's how it happened. And once he locked into the index fund concept and really thought, okay, I'm onto something here. Again, he became a champion of that cause. And you have to remember, Vanguard's ownership structure is such where the more assets they get, they'd use the profits to lower the fees because the investors own the company. So of course, what do they want to do with profits? Well, that they want to keep the profits, which means I want to lower fees. That's how I'll keep more of my money. So the index fund started at 46 basis points of a fee. That's 0.46%. And since 1974, it's now down to 3. And that's because, year after year, they just kept voting down the fees. So I do think the index fund is a big part of the story, but it's really that ownership structure that took that fee of that index fund down from 46 to 3 over 40 years. That is also a crucial part of the story. But again, a lot of serendipity was going on. And as you read in the book, there was a couple other moments that were really serendipitous where you almost felt the universe wanted this to happen. And because there was a couple million to one things that kind of played out that I thought were really interesting that I explore.
And that mutual structure that they have, that's still very uncommon, right?
Yeah, but no one's really copied it. There's no economic incentive to turn over all the future profits to your customers. I mean, that's almost like starting a co-op or a nonprofit, right? It's something. It's just not a capitalist move. This structure exists in the insurance industry a little more, but not really in the asset management industry. That's what made it unique. And it's interesting nobody's copied it. That was one of the reasons I wanted to write the book. Why has nobody copied it? Well, there's no economic interest to do that or incentive to do it. So then I was like, well, why did this guy do it? Because that actually was a really fun thing to explore. What made this guy different, unusual, the circumstance, to create some really almost like a freak of nature or freak accident structure. But I think the industry desperately needed it. And now, even though nobody's copied it, almost everybody has to copy it in the funds they come out with. So Fidelity has zero fee index funds. BlackRock has their cheap ETFs. Schwab has them. Even Goldman Sachs, JP Morgan, right down the line. Everybody now has to have a Vanguardian type offering because that's what the people want. So that's another reason I wrote the book, is that there's Vanguard's success, but there's also the impact they had on everybody else. So if you add up all the money going into funds in the United States, I'd say 80-90% of it is directly linked to Bogle, Vanguard, and low cost. There's still a small section for wild and crazy stuff, the stuff that's very unique, different, has a narrative attached, yada, yada. But the big blob of money is pretty much all dictated by the Vanguard structure at this point, even if it's not Vanguard's own funds per se.
Right, and that structure's almost created a cult-like following, which is definitely unique in the mutual fund and ETF world. So you talk about Bogleheads and their early meetings and some of the, I believe you actually got kicked out of their forum at one point and got back in.
I did.
But I think that's an interesting part of the story, the fanaticism. Sometimes when you're meeting with a young person, they'll say, I don't know anything about this, but my mom and dad told me to pick Vanguard funds. You'd be amazed how many times you hear that. But so let's get into that a little bit, the sort of fanaticism around this organization.
Yeah, and you bring up a good point with young people and older people. And I tried hard. This is part of another reason I wanted to write the book. I thought Bogle and Vanguard needed the Gen X treatment. I think most of the books written about him and by him were in a certain tone and style that is a little more boomer or old person. And it's fine. I mean, I think a young person can still get into that, but I did want to freshen it up a little bit, add some outside voices, and I even added in the forward is written by somebody from the crypto industry who used to be in the ETF industry because I wanted to explain to young people this guy was hardcore. This guy was exactly the kind of DeFi ethos that you like. He just looked like your grandfather, but he was punk rock at heart. And I really try to get that going so that younger people can be like, yeah, actually, this is not boring boomer stuff. This guy was the real deal. But you're right. I think the older people who saw what Vanguard was doing in the 80s and 90s, who were then young at the time, this is 80s and 90s, and even the 70s. Some people caught it on early, but over the last 35 years, people have been so moved by what this guy did and how unusual it is. He's almost spawned a religion. Bogleheads is probably the name for it, but they are a big force, and they are really pure. Their conferences don't have sponsorships. Their website doesn't have sponsorships. The website looks like it's still like in 1996. I mean, there's no bells and whistles. If you go on it though, it's good information, and it's very policed. I went on there trying to solicit some people to interview, and they kicked me right off. And it was a book on Bogle, but it didn't matter. And I kind of respected that. And at the beginning of the book, I say that to me, Bogle was part Steve Jobs, part Martin Luther. He was not a great investor, as Google says. Yes, I guess an index fund, and if you invest in it, makes you a great investor. But he wasn't that type of guy. He wasn't somebody who played the game well. He changed the game. So he made the products like a Steve Jobs, right? Steve Jobs delivered amazing products for people. He did that, but he also created a religion in like the way Martin Luther, stuck the thing to the church door and spawned all the actually multiple derivatives as well. And that's why there are different types of Bogleheads as well. But there's some core people who are definitely championing the cause, who set up different groups around the world at this point. And the way they talk about it, and they're having a meeting in October. They have annual meetings. There is a cult-like aspect to it for sure. And that's another interesting thing that I wrote about in the book is the Bogleheads really are really about low-cost philosophy. They're about Bogleosophy. Vanguard, the company, of course, is about that. But Vanguard, the company, has other fish to fry. Like they're in the wealth management business now, which has them getting into private equity, and they also have active funds. And there's a little bit of a gap forming between the sort of pure Bogleheads and Vanguard, the company. And I explore that in my book. I think it's a little overdone, but that's how unique the situation is. But I do think, unlike a hot manager that has like a good 10-year run, like a Peter Lynch, there's no Lynch heads that are going to be having meetings and talking about it. But there will be Boglehead meetings for a long time. This guy, again, he created a new religion or philosophy that has legs, because if you kick the tires on what he was saying, it just works. It feels right. It passes the sniff test for most people. There's nothing complicated about it, and it's populist. That it's for the people mostly, and that usually helps the message spread rather than just, oh, hey, look at this one guy who was a great money manager for 10 years. That's just not something everybody can share in. Whereas this is something everybody can benefit from equally.
And one of the things you do in writing this book, kind of for the next generation here, is you talk about some of the internal conflicts at Vanguard, which he was certainly not shy about to poke holes in some of his own products that were being developed down the hall or in the floors beneath them. So let's talk a little bit about that, some of the internal stuff, right up really till the end. He had issues with Vanguard and wasn't afraid to voice them.
Well, yes. And, I just spent a good amount of time sort of painting Bogle as this sort of, I don't know, Jesus-like figure, but he could be rough and cantankerous and very difficult to work with and savage. He just thought if you need a total market index fund, which holds all say 3,000 stocks, if you just buy and hold that for 50 years, that's it. So what caused some problems is anything that deviated from that, he would just crap on. And so, but Vanguard had products like the growth fund, the value fund. They had quantitative products. They have ESG. They have They even did some industry ETFs or index funds back in the day. Ironically, Bogle started many of these.
Mm.
So, but when Bogle left Vanguard as CEO, he retained an office on campus, and over the years, he would be the loudest critic of the company. And so here you have the founder on campus, just basically 100 yards from where they eat lunch every day. The cafeteria. Basically dropping bombs in the press on certain areas of Vanguard, especially ETFs. Vanguard had grown their ETF business pretty well, and Bogle just kept bumming them out by trashing ETFs, and it created a divide. Bogle also didn't like how big they became. He thought they were too ambitious, wanted too much money, too much. His biggest fear for Vanguard, even more than the ETFs and the trading, was that Vanguard would become so big they would lose the human touch with the clients, and they would become a bureaucracy. And he quote in his books, Bogle wrote like 12 books, which I read. I had read a couple, but I had to read all of them in preparation. In his books, one of the things he quotes a lot. I forget what the play it's from, but there's a quote: "Sir, we have found the enemy. It is us." Basically, I think it's from a war story where, they figure out they are their own worst enemy. So he thought the bureaucracy would be a problem, and that's what I read about. The customer service at Vanguard is becoming an issue. It's not getting good reviews. If you talk to people who use it, they all have their bad stories about waiting on the phone. And so I think that was his fear. And so his fear is kind of coming true a little. Again, this guy he was right on the money with a lot of things. That said, I thought he was sometimes too harsh with the company, and maybe a little too rough on ETFs. But I'm probably biased. I know, and this is where in the book I try to show you both sides, and you could be like, "Yeah, I'm with the old man on this one. I'm with the company on this one," because there's many issues they went back and forth with. But it was interesting, and that's also part of why I wanted to write the book. I would see Bogle drop bombs on his own company, but man, this guy's wild. I was drawn to his, like just total disregard of creating attention. I mean, he was fine creating attention, and he also would speak at conferences. He'd go to ETF conference, and they'd be asked him to speak, and he would trash ETFs right to the attendees. So he had a history of just doing and saying uncomfortable things and being savage right to the people's faces. And the reason he got away with it is, well, I mean, I would say he got shunned a little bit. It was not easy his whole career doing this. But over time, I think people were like, well, it's just Jack being Jack. And I also, I like a lot of them are Vanguard investors in the industry. So they appreciate what he did. And ultimately, I think in their jobs, Vanguard helped everybody get more fiduciary. And I think people want to feel good about what they do. So I think over the years, the company, other people he trashed, active managers, you name it, I think they all have a big reverence for Bogle, despite him biting them sometimes.
And so you had a chance to spend 4 or 5 hours with him on the record and record some. Did you find him likable? Is he somebody you enjoyed going to interview?
Yes.
Yeah.
He reminded me of my grandfather. He was a World War II generation guy. He was not a boomer. And what I mean by that is he had a great wit, right? He was very sharp. He liked to debate, but there was a soft middle. There was inside at the end of the day, he was a soft guy. And he was very polite. In our first interview, we went an hour and a half, and again, I'm bringing all ETF arguments at him. So he could have easily been like, "Get this guy out of here. I'm done with debating you." But he invited me to lunch. We went over to the campus cafeteria, and I also found it interesting that when he went to the cafeteria, he sat right in the middle. Like there was no special room. He didn't try to hide. He went right in the middle. I think he probably brought the average age of that room down to about 31. I mean, that's how out of place he was. But he just was not. He was just very comfortable with people in that way. And yeah, and so I liked it. I like that he's spirited for a debate, but it never got personal or nasty. It was more like, I don't know, maybe like academic rigor, as opposed to, oh my God, you're in an industry that I hate, therefore you're a bad person. And I wrote that in the book. He became friends with many active managers, and I think that's because he was very good about separating what somebody did for a living from the human being they were. Because you may be selling you may be a commission broker selling active funds, but you could have easily been friends with Bogle as a human. And he may even. So I think that's a good message. I think sometimes in this we're very tribal era, whether it's crypto or politics, everybody's in a tribe. It seems like, or passive even. It's okay. Like, you can do something different. We're all human beings, and I think that's a good message that he had that I felt when I was there, and that's what kept me coming back to interview him again and again, and exchanging emails with him and stuff like that. Like, for example, when Michael Kitces wrote this article, Michael Kitces is a blogger, about how it was really the internet that speeded up index funds, because the internet allowed information to get transmitted more widely, and everybody could then see, like, the emperor's new clothes with active funds easier, quicker, faster. And so I sent this theory to Bogle, and he wrote back like this, nice long email back that he went over, 5 reasons that it was more about him than the internet. But he just, and he didn't know that email would ever see the light of day. I mean, but he wrote this nice email, and that was a pattern I saw over and over. He wrote letters and emails, the old school, like, you know how back in the day people used to write letters to each other, long,
Sure.
Formal. He did it in letter form. Then when email came out, he started doing it with emails, and I thought it was a really good trait. And that goes a long way with people. When you write a follow-up letter, you don't just say, "Hey, thanks," but you actually write, "Here I am on a Sunday afternoon. I'm going to try to help you," and then you just give the time and attention to that note. And so I think that was also something that played well with me, at least, in that he was able to have this rigorous debate ongoing, not after our meetings, but then in the email form. Then he was on ETF IQ a couple times, and he kept in touch that way. So thought he was just a very down to earth guy. I could not imagine this with anyone else, at that level. I just think maybe you get to interview them once or twice, but I don't see them being that accessible that consistently.
What were your non-industry conversations about? What other topics, and did you enjoy those, or see some sort of crossover between his business mind and did you see that stretch into some other topics?
Yeah, I mean, I'd say we mostly talked about funds and ETFs and that kind of thing. But, like, for example, like, he knew I worked at Bloomberg, and he said, "Hey," because he saw I had a Bloomberg umbrella. He's like, "Hey, did you get Mike to? Mike can afford one. Did you bring me an umbrella? Just little stuff like that." He also was like, I remember he was one of the Time Magazine's top 100 influencers, maybe about 12 years ago. And I think Mike Bloomberg was also on that list, and they had interacted a little bit at the event, and he told that story. And then, he would talk a little bit about, his kids a little bit. We had sound checked. He said he was, had his daughter over for dinner. But I would say, honestly, 95% of it, like, was about that. But the good news is there was so much to discuss, and you could go anywhere with him: private equity, historical returns, ESG, smart beta, active versus passive. There was just so much to unpack. And then I interviewed him another time about a book about how passive managers run index funds. That was a whole long interview. And then the third one was really about his new book and what he was saying in it. But he would say something like, "I think in 30 years, other companies are going to be forced to mutualize like Vanguard." Well, of course, we're going to ask questions, and that's another 20 minutes just right there.
Yeah.
So that's how vast his mind was, and his knowledge, even at a late age, where he could rap about these very detailed issues for a long time. And so that's sort of what we did mostly, I would say. I wasn't like, I will say, I interviewed his son, and I interviewed Taylor Larimore, who's like the king of the Bogleheads, and a few other people who knew him well, who had a little more of a personal relationship with him, especially his son. I wanted to get a little feel for what he was like as a dad and at home and stuff, and I think I did that. But again, this book is really not. It's a character study to a degree, but it's also more about me trying to show you the ripple effect of this guy's work. And his personality is part of that, but it's a little bit in the backseat.
Mhm. And yeah, we should point out his son does run an active fund, right? We should throw that
Yeah,
out there.
that is
Which is fun.
interesting. Yes.
Yeah.
Yeah, I thought that was it just seems like that's how the universe works,
Yeah.
Whatever your kids will sort of like do the opposite of you. But his son obviously really really liked him. He called him, his dad is hero,
Mm.
um, and the way he got into active was a little different. But I think they were able to square each other, because also Bogle wasn't anti-active, as I point out in the book.
Right.
They have some active funds, so it's a little more complicated. I think Bogle sometimes gets painted as like an active hater.
Mhm.
I don't think that's true. I think he said the odds are so low, and the only way to overcome those odds or have a chance is to lower your fees.
Right.
But active itself isn't bad per se.
Yeah, people are always surprised about how much assets Vanguard has in active. It's
I
about
know.
active at the right price, right? I'd written down a couple quick hits here, so these could have been things you discussed or maybe didn't, but just I figured I'd throw these out and let you give a couple couple sentences on them. International stocks.
Yeah, Bogle did not. He thought they were unnecessary because the
Mhm.
U.S., I believe, 40% of the earnings from U.S. companies come overseas. So you're already connected to
Mhm.
overseas stocks that way. So I couldn't find anybody to agree with him on this. I think Taylor Larimore may have agreed with him, but um, even people who really subscribe to Bogleosophy were like, "I like my international stocks." As Dan Egan of Betterment put it, um, you know, Rome fell. In
Mhm.
other words, America may not always be the best country, the most profit. I mean, Bogle was very much in that Buffett mindset of like American innovation is so good, and really just keep your money here, you're fine. But
Mhm.
yeah, and he was right. He's been proven right so far, but we'll see what the next decade holds.
Yeah, right, and that sort of ties into my next thing, but because Vanguard has sort of tweaked up their international exposure on their target date funds. But what was his opinion on his target date funds?
Oh, he liked them. He crapped on almost every innovation that has come about or that is not an index fund. He
Mhm.
did like target date funds, though. He thought that they did a good job of making it easier for you. He just said, "Oh, I only say that with the sort of caveat that they have to be in cheap index funds. If
Mhm.
it's target date fund with active funds, he would withdraw that comment." But he did like the concept. He thought that was the rare good innovation in the fund world.
I'm curious too about his sort of his last few years when he was sort of on the outside looking in as far as Vanguard goes. Did you sense any sort of ill will there or anything back towards the company, or what were his feelings
Yeah,
on that?
it's complicated. I
Mhm.
think I won't go into all the details, but the CEO who came after him, they had some issues. I think largely because Vanguard went into ETFs. I think it was only 5 or 6 years after Bogle said, "No, I don't want to do it." And so they sort of overturned what his judgment was on that. And I think that had to hurt a little bit. And then I think Vanguard got really big under Jack Brennan, the next CEO. It started to really take off because here's a stat people are like blown away by: 90% of Vanguard's assets came after Bogle stepped down as CEO. 97%. So I think Bogle also may have had a little bit of maybe a little resentment that the other CEOs were getting more credit. Maybe it's hard to untangle Bogle being Bogle and just giving his honest opinion on it, and potentially maybe some hurt feelings. The people who are really love Bogle will say no, it's just the way he is, and then people who are a little more critical of him will be like, no, he's hypocritical. He's just had he was tossed out of there because he kind of get kicked off the board by his own company, which
Mhm.
again I thought was interesting. Like Wellington, they fired him. He got these new partners. They got voting control. They fired him. And then at Vanguard, when he was on the board was like, "You got to get out of here."
Mhm.
And again, it paints a human complex picture of the man. He wasn't like he could be difficult, and so I try to paint it. I try to show both sides because it's hard to really deduce the truth on this stuff because you have humans and emotions. But I've interviewed 50 different people and I put their voices in there, as you know from the book, so that you can maybe get an idea from this semi-documentary style where the truth is, because I can't say for sure, but he definitely was critical of the company right up until the end. He wrote his last Wall Street Journal, his last article 6 weeks before he passed away was in the Journal, and it was about how indexing was getting too big. Although
Mhm.
it's not really what he said. He was a little worried that the too big BlackRock and Vanguard were getting too big, and they would have too much voting control. What he really wanted was for more competition to come out. So his real problem was he wanted other issuers and fund companies to get cheaper quicker, and
Mhm.
therefore Vanguard wouldn't have to be getting so much money. And now BlackRock. So he thought BlackRock is the only company that seems to be able to go toe to toe with us. We need more people who can do this, which is why one of the quotes that I read of his in one of his books that I did not know before, wasn't one of his famous quotes that I was blown away by, was he said that in 1993, this is very early on, they only have like $300 billion at this point, something like that. He said, I'll know that Vanguard's mission has created a better world for investors when our market share begins to erode.
Right.
And I thought that was really crazy. I mean, who's ever wished for the market share to erode? That makes no sense business wise. And to say that in 93, their market share has been growing ever since. I don't know when it will erode. So that's why I have this recurring note saying that Vanguard grows, but Bogle's dreams still on hold,
Right.
which is ironic.
Yeah.
But that's how big this guy thought. If you just think about that quote for a little while, you're like, wow, this guy was on a different trip. And so I don't know. That's why, again, but he's not above, he's a human being, and he's,
Mhm.
imperfect and flawed. But I think he's right up there in terms of good guys, but certainly not perfect.
Yeah. So overrated or underrated, you're going to lead towards underrated, right?
I would lead toward rated relative to the whole Wall Street apparatus and even business in general.
Mhm.
I sometimes I'll find somebody who really goes after Vanguard. There's a couple people very critical, and I just can't view Vanguard in isolation. Where I'm like, this company right over here did this one thing that was just they messed up, bad, bad. This company, oh, it's like they're trying to find something. There's not a lot there.
Mhm.
I can't help but look at this in the whole picture. And when you do that, you sort of it's like, okay, they're 98% good. I'm just not going to spend a ton of time on the 2% and make it seem like it's 50%. It's
Mhm.
just not right because I see the whole picture. So I would say underrated for that reason versus the whole
Okay.
picture.
And you started writing the book after his passing, right?
Yes, I started in the pandemic, so March 2020ish.
All
It
right.
was
Did you feel when you were writing
year.
the book, was there one question you're like, man, I wish he was still around. I'd go back and ask him this.
Yeah, there were a couple. One of them was ESG,
Mhm.
but then I had found the interview my colleague Mike Regan did with him that he actually commented on ESG, and I was able to use that. Although I would have liked to follow up. I felt that I would have phrased it and gotten him to get a little more Boglean. The other
Mhm.
thing, of course, was Robinhood. I mean, I asked people about Robinhood and the YOLO day traders and GameStop, and I was just like, this guy. I was like, what do you think he would have said? And everybody's like, oh man, his head would have exploded. I mean, he would have gone off. His language would have been colorful, funny, and just out of control. So I really wish we could have heard him on that. I think that whole Robin Hood thing from like during the pandemic would have been classic Bogle.
Yeah, it's amazing. He's only been gone for 3 years, and you think of everything that's happened in that 3 years time. You could do another book just on that, of course. Um, and the last question: did you ever get any feel for him of the retirement plan industry, and did he think that was another area that was kind of ripe for disruption, or was kind of happening on its own?
Sure, I mean, he really had problems with it. Some of it, I think he liked the idea of a a DC plan and you saving for retirement with your company helping, but he had issues with it. There was a lot of fees going on that he wasn't a fan of. Um, I do in the book highlight this guy Jerry Schlichter. I don't know. Do you
Mhm.
know who that is?
Sure. Yeah, the attorney. Yeah.
Yeah. I didn't totally know what this guy did, but this is a lawyer
Yeah.
who went and sued Fortune 500 companies like Lockheed Martin, I believe is one of them, like big, highly lawyered up companies. This is hard to do. Almost like what's that movie with Julia Roberts? But anyway, So he and his partner found that the funds were giving sort of kickbacks, and the 401k options were largely high cost active because of some fee arrangements that benefited the company. In other words, the 401k plan person wasn't being fiduciary because they didn't have any cheap options. So Schlichter sued the 401k plans, and he won, and he won again and again. Now the companies have sort of they're like now they're moving just so they don't get sued. So this guy actually deserves credit, and it's interesting. This guy went to see Bogle. It's like going to see Yoda or something before your big adventure with the Empire.
Yeah.
And he went to see Bogle and told him his plans, and Bogle was like, gave him his blessing, said, "This is great, you should do it." And he did it, and he actually was able to win in the Supreme Court, which Bogle had actually tried to do a couple things on that front, and it was hard to do. It's hard to get some of this stuff regulated, like dollar fees, and it's just tough. A lot of the language sort of puts it on you. So this guy, I think, deserves some good credit. But again, I don't know if this guy could. I mean, he couldn't have done it unless there was a practical alternative to these other funds.
Right.
If they're only high cost mutual funds, what point does it make to call them out? There's no other choice. But when you have a practical choice that's cheap, and we know how much it can help you long term, it is a little disingenuous of the 401k plan not to at least offer that option, not to just make it the only option, but to offer it. And I think that, again, Schlichter could only do what he did if Bogle had given the practical tools that provided an alternative. So I think this is where you really start to trace out Bogle's impact. And honestly, there's so much going on, but just creating a low-cost index fund just has all of these side effects that are good. And I think it really helped behavior. I think as we're seeing in this market sell-off, and we see in the past one, if you own a cheap index fund, there's just more of a thought in your mind. It's like, what am I going to do? Sell out of this and go into what? So people are just like, I'll just stay in there. I'm in a good deal. I got a good deal. That's a major benefit to behavior, because it's not like back in the day, we might be in an active fund. Oh, it's underperforming, I'm going to go to a different one. You panic. Now with this, I just think it's just made life a lot easier for people in general. And there's also the time savings, where in the idea that when you have that resignation to that low cost index fund, you're secure, you've got a good deal. You don't have to worry about it. And I think even during sell-offs, you can just be like, yeah, whatever. And we see that in the flows. The Vanguard type investors are just like, whatever. They are not capitulating. If anything, they're just dripping more money into their funds. So I think I rambled a little bit, but
no, that's a good answer. No, I'd be very interested in that.
Some of
It
this
almost
stuff
makes
just
you
leads
wonder.
to other stuff.
Yeah, it almost makes you wonder
Yeah.
sometimes how other S&P 500 or any broad market funds still exist. It's like, what are you comparison shopping for? If you could get this one for 5 basis points and this one's 25, how is there even a nickel in the one that's 25, right?
Yeah, well, because somebody's paid to put them there,
Yeah.
or wholesaler is friends with some of the advisors, so something like that.
Mm-hmm.
But that's also proof that had there not been Bogle or Vanguard, I do believe index funds would exist. I just think they would be 80, 90 basis points. And I think they'd be niche. I think some people might be into them, but 90 basis points makes it active a lot more competitive. But when you get down to zero, active has so much to overcome just to get to the starting line. That's why it's almost like it's game over, because they're so cheap. So, but yeah, I do think there's something to say for that.
And the one place that hasn't made huge inroads yet is in the endowments, right? One of the best stories I found was the class of '69 that was Harvard, right?
Yeah.
Was it Harvard? Yeah,
Yes.
Class of '69 that wrote the letter trying to get the endowment to use more index funds and save money on fees. But it's people trying to justify their position and stuff, right? I mean, they can't.
Yeah.
If somebody says go all index, what are they paid to do, right?
Yeah, the institutional world, which I wrote about in my ETF book a little bit too. Look, I don't want to be too judgmental. I think there's a lot of conflict of interest, because if you go to a couple cheap index funds, two things happen. One, you don't need a staff, and you have less power, and you don't have hedge funds kissing your butt. Private equity. It's nice to get your butt kissed. Somebody said a pension fund manager is like the greatest government job in the ass kissing department. But anyway, the other thing that it does is that if you have a cheap index fund, you're sort of in control. And let's say the index fund has a bad quarter, or a year, or whatever, you're now responsible. So some of the institutional world, they like the churning of active funds and hedge funds and private equity simply because it can give them somebody to blame when it goes wrong. And they can have a whole staff who's doing all this research and stuff like that. So the class at Harvard was like, what a waste of time.
Mhm.
Just have one person there and go into index funds. And some are moving that direction. Now, to just maybe give the other side of the story, institutions do have different needs than retail. Some of them have certain income needs, and they do have a longer maybe horizon. If they're really big and they get access to some top shelf private equity or hedge fund type situations, some of those are really, really good opportunities. Where I think the Vanguard effect should really kick in is the middle to small institutions. You don't want like the Peoria, Illinois Fireman's Pension Fund messing with hedge funds, in my opinion. I think just put that in like a 3 ETF portfolio and be done with it. So it's that middle to small area that I think it's really wrong, I think, for them to be in crappy hedge funds, PE, and lose money. The big guys, I think, like a Yale, Harvard, CalPERS, I think they are given access to the best stuff. And I think there's probably some good opportunities. I don't want to say it's all bad. So it's a complicated question, but I do think they're ripe for more Vanguard effect. I call it the Vanguard model because it's playing off of the Yale model, which is what a lot of them subscribe to, which is all about owning more alternatives. But I think that will slowly infiltrate that world as well, because again, if you think about low cost indexing and investing, it's just good for the end person. And usually something that's good for the people will slowly just break down these artificial barriers and conflicts. It just eats away at it. It's like the walls come down, just like democracy. It's just harder in that world given the vested interest.
And some of it's just generational turnover of the staff that's putting it together. If you've got a whole group of the next generation who's grown up on index funds and all that kind of stuff, when they're getting in these positions, they're going to say, well, what are we still doing in this stuff, right?
And if you, when I did my ETF book, I interviewed several ETF wholesalers about their experience trying to sell to institutions. And the story I heard a lot was the person running the fund, pension fund endowment, was like, they had all these questions for me. And then I realized they weren't going to use the ETF in their pension fund, but it was for their personal account. And this is a story that I heard a lot with Vanguard, a lot of active managers, CEOs. One of the biggest hidden secrets in the whole financial world is that most people in this universe privately are in Vanguard funds or low cost index funds. And I think that should tell you a lot about, because they know what they're doing. These are smart people. And they may, dabble in things, and these other active funds may have a role. I don't want to discount the whole thing, but I do think that is sort of the ultimate compliment when I would hear these stories over and over. So you have to wonder if you, the CIO of this endowment, are putting your kids' college education here, why not put the endowment's money here too? Wouldn't that make sense? But I mean, I guess I'll let them defend that. But yeah, there's definitely, I think, some calls for them to do that more.
Yeah. Well, we could probably talk all day, but I'm sure you have time commitments as well as I do too. Anything else from the book that you think we missed, or something that's really important that's going to make people want to run over to Amazon and buy it?
No, here's what I would say. I said, if you're young, and this guy was doing, this whole idea of trying to be a good corporation, right? You're not just in it to make a ton of money. There's a trend among millennials and Gen Z to do and operate. It's more of a thoughtful capitalism. This guy was pioneering. This is the OG of thoughtful capitalism. I think anybody reading this who has a business or is in investing, I think this is a very inspirational business story, as well as a investing story. I think the investing story, because I've read so many books that are written by smart advisors, and a lot of times at the end of the day, the conclusion is just buy and hold a total market index fund. And that's what the person says they do with their own money. So honestly, when it comes to investment advice, hopefully this book will show you that. But that's easy to say. I just said it in 2 sentences.
Right.
The rest of the book is this just story about this guy who toiled around in oblivion for about 25 years with this message, and he was outside of the system. He did not pay any brokers, and that's how the whole industry worked. It's like making a movie that the theaters and the cable channels will not run, and you have to find a way for people to come to you. And so anybody, I think, could benefit from this. And I think another big message in this book is make sure to throw the customers a bone once in a while, like whether it's sharing in some profits or communication. I think you just can never take your customers for granted. And there's a good business story here too. So I just want to make that pitch, I guess, to anybody watching, that it's a lot more than a investing book that goes over mutual funds. There's a lot of good stuff here for people to apply to their own worlds.
Yeah, those are really good points. He was kind of ESG before it was a thing, right? His whole company is sort of based on those principles, at least the governance part of it.
Oh yeah, I mean, this guy was miles ahead of many of this sort of not just the things we see, but the vibe, the spirit that exists now. He had it early, and I have a section in the book where I talk about 1987, which I don't know how old you are, but in '87, I mean, Wall Street was going wild. Everybody was doing cocaine and making a ton of money, and there was the movie Wall Street where Michael Douglas plays Gordon Gekko. He says greed is good, and it inspired all these people to go to Wall Street for the wrong reasons. But anyway, as he's giving that speech, Bogle is giving a speech at his Christmas dinner. And it's like, hey, we're going to lower 2 basis points off the fees. If we treat our customers properly and be fiduciaries, over time, we will win this race. And I was amazed at just how consistent his message was while Wall Street was going up and down and this trend and that trend. And he just stayed rock solid. Then the world turned and almost feels like what he was saying was trendy. But he was saying the same thing for 30 years. And I think that is interesting and gives testament to how much longevity I think his message in Vanguard has. The world just sort of caught up to him, I think, and I think those stories are always so fun to me, where somebody's is onto something, a couple years before the public, let alone decades.
Right.
So yeah.
Okay. He's Eric BALCHUNAS. He's at Eric BALCHUNAS on Twitter. Really great follow on Twitter. Tweets quite a bit. So some good stuff in there. It's BALCHUNAS, and his book is available on Amazon. Been out a few months now. It's The Bogle Effect: How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. He also wrote the Institutional ETF Toolbox for a few years ago, and ETF IQ is back on the air, right, on Bloomberg.
Yep, Mondays at 1 p.m., or you can just Google ETF IQ and watch the old episodes digitally. But yeah, it's back. I'm happy. Good show.
Sounds good. All right. Thanks, Eric.
Thank you so much.